Okay, so we're looking at PPE part 2 this week. So last week, you would have looked at a definition of property, plant, and equipment. And you would have looked at how to recognize property, plant, and equipment. What was the recognition criteria? Then you would have looked at how to recognize significant parts by using the component approach. You would have looked at initial measurements, how to account for property, plant, and equipment at acquisition date. So there you had to calculate the initial cost of PPE. Then you had to identify the method of acquisition. Was it acquired via cash or using cash equivalents? Maybe it was exchanged with another asset. Then subsequent measurement, which is also important. So you have initial measurement and subsequent measurement. There you would have looked at how to measure property, plant, and equipment subsequent to acquisition. So here we have two models, the cost model and the revaluation model. So last week you would have looked at the cost model, and we'll be continuing with the cost model this week. And then next week you'll look at the revaluation model. So the cost model is something you would be familiar with. Then we worked out how to process depreciation, and you also would have processed impairments. Okay, so what are we actually going to do this week? So this week we are looking at subsequent expenditure. So how do we account for subsequent costs? So here there are various costs we'll look at. We'll look at improvement costs. When are we going to capitalize costs? If it is an improvement cost, we'll capitalize them. And servicing costs, these costs are generally expensed. Then we're going to look at replacement of parts and how to de-recognize an asset. And we're also going to look at a situation where we have a major inspection. So some assets require major inspections, and we need to know how we're going to deal with that too. Then we're going to look at disposals under derecognition. When do we derecognize an asset and how to account for it? And then we're going to look at a change in estimate. So what is a change in estimate? And we're going to see how to account for it. And for this module, we just look at the reallocation method. Then we're going to look at presentation and disclosure. How do we present and disclose PPE in the various statements? So we're going to look at the statement of comprehensive income, the statement of financial position, and the notes to the financial statements. Okay, what is out of scope for this module? So if we look here, we'll see the sections that are out of scope. So chapter 7, if you're following in the textbook, items acquired via a government grant is out of scope. Future costs cause increases over time. That is also out of scope. If you look at section 7 in chapter 7, the cumulative catch-up method is out of scope, but we are only going to focus on the reallocation method. So if you see the cumulative catch-up method, you can ignore that for this module, but you must know the reallocation method. So deferred tax consequences are also out of scope. And then section 7 looks at further encouraged disclosure and disclosures regarding fair value measurements. Those are also out of scope. Okay. So what is subsequent expenditure? So after initial cost, additional costs may be incurred in relation to the property, plant, and equipment. So these costs are called subsequent costs, okay? They are incurred subsequent to the like initial acquisition of the property, plant, and equipment. So these subsequent costs include things like day-to-day servicing, improvement costs, replacement of parts, and major inspections. So subsequent costs are added to the cost of the asset only if the recognition criteria is met, okay? So we can only capitalize and add the subsequent costs to the asset value in our books if the recognition criteria is met. And the recognition criteria for IS 16 is that the cost is reliably measurable and leads to probable future economic benefits. So that needs to be proved before we can capitalize subsequent costs. If the recognition criteria is not met, then the cost will need to be expensed. Okay, so we're either capitalizing the subsequent cost or we are expensing the subsequent cost. So if the recognition criteria is not met, we cannot capitalize the subsequent cost and it must be expensed. So let's have a look at the first type of subsequent expenditure, which is day-to-day servicing costs. So these costs include, but are not limited to, maintenance costs, service costs, labor, consumables, and small parts. So the purpose of these expenditures is often used for repairs and maintenance, which is also known as upkeep expenditure. So when we have these day-to-day servicing costs, these costs are always going to be expensed in the statement of profit or loss, even if they are material in amount. So what would the journal entry be to expense or record a subsequent day-to-day servicing cost? Okay, so if we have a service cost and it is a day-to-day service cost and we need to record this in our general journal, what would the journal be? Okay, so we have just said that we are going to expense these costs. So we are going to debit maintenance expense slash servicing cost. Okay, so the account, you can call it maintenance expense or service cost. But what is important is that you must show it is an expense. Okay, it's very important that you show in brackets that this is an expense so that we know where it is going to go. Okay, so you're debiting your expense account and then you're going to credit bank or credit payables depending how the item is paid for. Okay, so depending if it's bank or payable, that will determine the element, whether it's an asset or a liability. Okay, so from this slide, you need to know that day-to-day servicing costs are always going to be expensed. And this is the journal here for these costs. Okay, so we're going to debit our expense account and then credit bank or payable. Then we have another type of subsequent expenditure, which is called improvement costs. So these costs are often referred to as capital expenditure because they increase the value of an asset, or they could increase the useful life of an asset. And they generally increase the future economic benefits associated with the asset, but they could decrease the running costs. So it could be like a technical innovation, something that is more efficient that will decrease the running costs. It could increase the units produced. Perhaps there's an improvement on the machine and all of a sudden it makes 1,000 units instead of 100 units, okay? So that will result in an increase in future economic benefits. So there could also be an improvement in the quality of goods being produced or the service being provided. So maybe the machine now is able to make a better quality product. Perhaps it was making a food item like maybe it was icing a cake. Okay, maybe the machine was icing a cake, but it didn't look very nice. So now there's an improvement and the quality of the icing has improved. So these costs are always going to be capitalized to the cost of the asset. So once these costs are capitalized, the revised cost or carrying amount must be used to calculate the depreciation expense in the subsequent accounting period. Okay, so we are going to capitalize these items. Okay, so we're going to debit the asset cost and then we're going to credit bank or payables. Okay, so we are going to debit our asset. This is showing that our asset value is increasing. And then we are going to credit bank or payables. Okay, So that is the improvement costs. Then we need to look at capitalization of a new part. So in the property, plant, and equipment definition and recognition criteria given in IS 16, if these are met, the cost of the replacement part can be recognized as an asset, okay? So sometimes a new part needs to be capitalized. Maybe we are installing a new engine or a new part. So if the property, plant, and equipment definition and recognition criteria are met, the cost of the replacement part can be recognized as an asset. So if the cost of this new part is significant in relation to the value of the asset as a whole and has a useful life and method of depreciation that is slightly different to the rest of the asset, then this new part must be recorded in a separate asset account. Okay, so think of like an airplane or will have an engine and then it will have like the chairs inside and then it will have the body of the plane. So all of these could have different useful lives and the value of these things will be significant by themselves. So in that situation, we would record these items separately for, say, an airplane. But you have to be guided by the question. So the question will say that each part is significant and it will give you the useful life and how you must depreciate each part. So you need to do an assessment and determine if the method of depreciation is different and if the question is telling you whether it's significant. Okay, so however, there could be immaterial replacement parts, and these should be expensed as day-to-day servicing cost. Okay, so say for example, I have a car and I replace the windscreen wipers. Okay, so that is an immaterial replacement. It is not a it is not like a significant value and it's not going to be depreciated. So if we have a situation where we are replacing an immaterial part, then that should be expensed as day-to-day servicing. Okay. So let's have a look at an example on the 10th slide. So here we have an example of Small Limited. They owned a car that had a carrying amount of 30,000 on 1 January 2019. Details of this car recorded as two significant parts were as follows on 1 January 2019. So car structure, which is 20,000. The car structure had a remaining useful life of 10 years and a nil residual value. Then we have car engine, which is 10,000 Rand. This had a remaining useful life of 2 years and a nil residual value. So you can see here that each of them have different useful lives, okay? And they are separate parts. And they tell you there that there are two significant parts. So the old engine, which originally cost 12,000 Rand, was scrapped and replaced on 1 October 2019 at a cost of 15,000 Rand. The new engine has a useful life of 3 years and a nil residual value. The straight line method is used. So we need to show journal entries relating to the purchase of the new engine. So here we have our journal entry. So the question on the 1st of October. So remember that the old engine was scrapped and replaced on the 1st of October at a cost of 15,000. So we need to scrap the old engine before we can record the new engine. So we need to process the depreciation first for the car engine. So there's two car engines, the old engine that we need to scrap, and then we need to record the new engine on the 1st of October 2019. Okay, so the question gives details here of the old engine, which relates to this engine here. And then the new engine of 15,000 Rand also needs to be recorded. So let's start with the old engine. So they told us that the car engine had a remaining useful life of 2 years and a nil residual value. So the old engine was scrapped and replaced on 1 October. So we need to make sure that we have processed the depreciation for the old engine. So the old engine had a carrying amount of 10,000 and a remaining useful life of 2 years. So we're going to take the 10,000 Rand, which is the carrying amount of the old engine given in the scenario, and they told us the residual value was nil. So we're going to minus the residual value of nil, and we're going to divide that by the remaining useful life, which was given of 2 years. And then we're going to multiply by the number of months from 1 January 2019 to just before it was scrapped. So it was scrapped on the 1st of October. So we can't depreciate it for the month of October, but we can depreciate it from 1 January to 30 September. So if we count the number of months from January, 1 Jan to 30 September, you'll see that we get 9 months. So we are going to prorata the depreciation for 9 months. We cannot depreciate this asset after it was scrapped. Okay, when we scrap it, we're going to remove it from our accounting records. So we're going to go debit depreciation vehicles with 3,750. So we are prorating the amount. And then we are going to create a vehicle engine with the accumulated depreciation. So you'll see here that when they process these journals, because there are significant parts, you need to specify what parts are you depreciating. So here it is clear that the accumulated depreciation relates to the vehicle engine, okay? So it is clear that the person, like the marker or someone else in the business, can come and say, yes, this depreciation relates to the vehicle engine, okay? Because we're going to have many assets, and then also when the assets have different parts that are significant, we need to specify which parts are we depreciating. So we've depreciated the vehicle's engine to the date of the replacement. Then at the date of replacement, we need to work out the value of the old engine, and we're going to scrap it. So we need to process an impairment loss. Okay, well, we need to test for impairment. Because it's being scrapped, it's likely that it's damaged in some way, and an impairment needs to be processed. So we are going to work out our impairment by taking, so we need to work out the carrying amount at the 1st of October 2019, and then we're going to reduce that carrying amount to 0. So the car engine, remember they told us that it had a carrying amount of 10,000 Rand on 1 January 2019. So now we are minusing the depreciation that we calculated. That is depreciation from January, 1st of Jan to 30 September. And that will give us a carrying amount of 6,250 Rand. So once we have determined the carrying amount on 1 October 2019, now we need to scrap that amount, okay? We are going to impair it. Obviously, there's been some kind of damage and it's no longer actually worth that. So we are going to process an impairment. So the recoverable amount is basically 0. So we're comparing the carrying amount of the old engine, which we said was 10,000 Rand, which was the carrying amount on 1 Jan 2019, minus the depreciation of 3,750. So that gives us a carrying amount of 6,250 Rand. Now we're comparing to a recoverable amount of 0. So we need to now bring the carrying amount of the car engine down to the recoverable amount of 0. And this is going to result in an impairment. So we're debiting impairment loss vehicles, okay? It's the car engine basically. And an impairment is an expense. And then we are crediting vehicle engine accumulated impairment loss. And this is a negative asset in the statement of financial position. So now we have impaired the old engine. We have basically reduced the carrying amount to nil. Now we need to de-recognize the old engine. So still in our books, even though we've impaired the asset, we need to remove the cost of the engine that would have been recorded, and we need to also reverse the accumulated depreciation and impairment losses. Okay. So let's have a look at this last journal, and then I'll have a look at some of the questions. So now we're going to de-recognize the old engine. So when we bought the engine, we would have debited vehicle engine cost. Now we need to credit vehicle engine cost. We're removing that cost from our accounting records. And when we recorded accumulated depreciation and we have accumulated impairment losses, those were credited. So have a look at this previous journal. There were credits to these amounts. There were credits to the accumulated depreciation and credits to the accumulated impairment losses. So now we need to debit these accounts. Okay, so remember that 10,000 Rand, that was the carrying amount on 1 January 2019. They told us, the original cost of the old engine was 12,000 Rand. On the 1st of January 2019, the opening carrying amount was 10,000 Rand. So the original cost of the old engine was 12,000 Rand. Then they told us that the carrying amount on 1 Jan 2019 was 10,000 Rand. So from this, you can see that before the current year, so in the prior period, 2,000 Rand of depreciation would have been processed, okay? So now we're removing all the previous accumulated depreciation. So we're going to remove the 2,000 Rand, which is the difference between the original cost and the carrying amount on 1 January 2019. So this 2,000 Rand, this relates to depreciation in prior years. So we're going to remove the 2,000 Rand, okay? Then remember that we still need to depreciate from 1st of January 2019 to 30 September 2019. So we depreciated the asset for 3,750, and that results in total accumulated depreciation of 5,750. So here we are adding the 2,000 Rand depreciation from prior years, and in the current year depreciation of 3,750. And that will give us total accumulated depreciation of 5,750. We are removing that from the records, okay? So then we are debiting vehicle engine accumulated impairment loss. So remember we processed an impairment of 6,250. So we're debiting vehicle engine with the accumulated impairment loss. We are taking out the impairment loss. We are reversing it. It was processed if like on the 1st of October, but now because we have scrapped the asset, we actually need to remove the cost and accumulated depreciation from our records. Okay. So someone is asking, isn't the 12,000 the original cost? So yes, the 12,000 is the original cost, which is why we are crediting vehicle engine cost. But remember in the scenario, I think maybe you're confused with the 10,000. So in the scenario, the 10,000, this is the carrying amount on 1 January 2019. The original cost was 12,000. So you can see that we are taking out the original cost, and then we use the original cost and the carrying amount. The difference between these two was depreciation relating to the prior years. So we're also taking that out. So we have removed the accumulated depreciation and the accumulated impairment losses, and we have removed the original cost of the engine. Okay, so we depreciated the engine for the current year. We processed an impairment. Then we removed those items relating to the old engine, like the cost and the accumulated depreciation and impairment. Now we need to record the new engine. So they told us in the question that the new engine had a cost of 15,000 and it was bought on the 1st of October 2019. So here we actually need to depreciate from 1 October 2019. So we're going to record the new engine. We're going to go debit vehicle engine cost with 15,000. This is an asset. and we are crediting bank or trade payables, depending if we paid cash or bought it on credit. So that is the purchase of the new engine. Because the new engine was purchased partway through the year, it was purchased on 1 October, we need to depreciate this engine for those months. So if we count October, November, December, that is 3 months. Now we need to work out what is the depreciation relating to this engine cost. So we are going to depreciate the engine. So we're going to take the cost of 15,000 minus the residual value, which is 0, and the remaining useful life is 3 years, and we had it for 3 months. We bought it on the 1st of October, so we have it for October, November, December, so we need to pro rata it for 3 months. So we're timesing by 3, dividing by 12, and that will give us depreciation relating to the vehicle engine of 1,250 Rand. But remember that the vehicle engine is only one part of the asset. We still need to depreciate the vehicle structure. So the vehicle structure had a carrying amount of 20,000 on the 1st of January 2019. So we need to depreciate this over the remaining useful life of 10 years. So the residual value is 0. So we're going to go 20,000 minus the residual value of 0 divided by 10 years. And we had this vehicle structure for the full year. So we do not need to prorate it. And that will give us depreciation relating to the vehicle structure of 2,000 Rand. So when you do this journal, you'll see that they debit depreciation and then they credit vehicle engine accumulated depreciation, and they created vehicle structure accumulated depreciation. So, but they only process the depreciation once, okay? So this is a good way to do it. If you were to do separate journal entries though, maybe you debited depreciation and then credited vehicle engine accumulated depreciation with the 1,250. And then you did the same for vehicle structure. Maybe you debited depreciation again with 2,000 Rand and credited vehicle structure with the accumulated depreciation. So, I mean, they both are correct. This method given in the solution will save you a bit of time, but if it makes sense to you and you feel you're less likely to make a mistake doing the other way, then that's what you can do. Okay. So this is the replacement of a part. So we impaired and depreciated the old engine, and then we removed it from our books and we recorded the new engine. Okay. So let's have a look at major inspections now. So sometimes we have an asset that requires a major inspection. This is like a ship or an aeroplane. So the inspection needs to be recognized as an asset. So obviously this inspection, it's quite an expensive thing and it's very important. So that means that the inspection can be recorded as a separate asset. So when an asset requires regular major inspections, as a condition to its continued use, the cost must be capitalized as soon as either the cost is incurred or an obligation arises. So the major inspection asset is then going to be depreciated over the period until the date of the next inspection. So if the question says the inspection must be done for 3 years, then that major inspection asset will be depreciated over 3 years. Okay, so it's whatever interval or time period the inspection is for. So if the cost of the inspection asset is significant and the rate and method of depreciation of the inspection differs from that applied to the other parts of the related asset, then the cost of the inspection must be recognized as a separate part. So often the inspection will be for a few years or maybe every year. So often the inspection will have a different useful life to the rest of the asset. So take, for example, an aeroplane. If an aeroplane needs to be inspected every 2 years, the inspection assets will be depreciated over 2 years. But the rest of the plane could be depreciated over 10 years or 20 years, depending on how long it is expected to be used for. Okay, so let's have a look at an example. So here we have new legislation was promulgated on 1st September 2019, whereby all public transport buses are required to undergo regular major inspections every 2 years. Good Limited owns a bus that had a carrying amount of 80,000 as at 1 January 2019. A major inspection of this bus was performed on 1 October 2019 at a cost of 20,000. The bus is depreciated on a straight line method to a nil residual value over its remaining useful life of 10 years, calculated from 1 January 2019. So we need to show the journal entries relating to this major inspection. Okay, so the first thing we need to do is we need to record the inspection. Okay, so we need to show the journal entries relating to this major inspection. Okay, so they told us that the bus needs to be inspected every 2 years. So let's go to our solution. So the bus needs to be inspected every 2 years. It says that a major inspection of this bus was performed on 1 October 2019 at a cost of 20,000. So we are debiting bus major inspection cost of 20,000 and we are crediting bank, which is an asset, with 20,000. So this inspection was performed on 1 October 2019. Then at the end of the year, we need to actually depreciate this inspection. So they told us that an inspection is required every 2 years. So we are now going to depreciate the inspection, and we're going to depreciate the inspection separately from the rest of the asset. So let's have a look at the inspection first. So here the inspection had a cost of 20,000 and there's no residual value when we deal with inspections, but the remaining useful life is 2 years. So we are taking 20,000 Rand divided by 2 years, and then we are seeing how many months we had this inspection for. So we inspected the asset on the 1st of October, and now we need to depreciate from that date. So we're depreciating for October, November, December, which is 3 months. So we're timesing by 3 over 12. And that will give us 2,500 Rand. So because the inspection was performed partly through the year, we are going to prorata it. So we are crediting bus major inspection with accumulated depreciation of 2,500 Rand. Now we need to depreciate the rest of the assets. So it says that Good Limited owns a bus and it had a carrying amount of 80,000 Rand on 1 January 2019. The bus is depreciated to a nil residual value over a useful life of 10 years. So now we need to depreciate the bus over 10 years. So we are crediting bus accumulated depreciation. So the value of the bus was 80,000 minus the residual value of 0, and the useful life was 10 years. So we are dividing by 10 years, and that will give us accumulated depreciation of 8,000 Rand. So now we have accumulated depreciation relating to the bus, and we have accumulated depreciation relating to the major inspection. So we can add those two together and then debit the depreciation account with 10,500. Okay. A student is asking, how is an inspection an asset? Okay. Remember I told you, if we go back to the slide, when an asset requires a major inspection, the cost must be the major inspection must be recorded as an asset. Okay, so read this slide. So when the cost of the inspection asset is significant and the rate and method of depreciation differs from the other parts, then we need to record the inspection as an asset and we need to depreciate it. Okay. So how is an inspection, how improves the useful life of an asset? Okay, so if we go to, so the major inspection, it's not really going to improve the useful life, but it says here that without the inspection, the bus cannot operate. So without the inspection, the bus cannot operate, therefore there won't be any economic benefits from the bus, okay? So an inspection can be there required by law. It doesn't mean that it's going to improve the useful life of an asset, but it can result in future economic benefits because without the inspection, the bus would not be able to operate. Okay. Um, so it says here also that it just gives you some extra information. The inspection is going to be recognized on 1 October instead of the 1st of September 2019. So even though there was a new law, the law does not create an obligation for Good Limited because Good Limited can decide not to drive the bus publicly. So the obligation only arises when the inspection is actually performed. So the major inspection has a different useful life to the physical bus. So we saw that the major inspection had a useful life of 2 years and the rest of the bus had a useful life of 10 years. Yeah, so that is some extra information. So have a look at that, guys. Okay, but now sometimes, so we saw that situation where we have a major inspection that is purchased, but sometimes we have a situation where an entity buys an asset that on the date of purchase has already been inspected, and it does not require another inspection for a period of time. So the cost of that asset must be separated into the cost that relates to the physical asset and then also to the cost that relates to the balance of the previous major inspection purchased. So here we are going to buy an asset and maybe the inspection was done last year, but the inspection lasts for 3 years. So when we pay for that asset, we're not just paying for the physical asset, we're paying for the inspection that was performed and the remaining period relating to that inspection. So the cost of the inspection need not be separately identified on the sale document. So it can be an estimate of the cost based on the expected cost of future similar inspections. So when you buy an asset, it's not always going to say that, this portion of cost relates to the previous inspection and this portion relates to the actual asset. But we can estimate the cost of the previous inspection by looking at future inspections and the cost of those future inspections, and then obviously present valuing it. So let's have a look at this example. So here we have a major inspection purchased as part of an asset. So the ship is purchased for 1.3 million cash on 1 January 2021, when its economic useful life was estimated to be 10 years. The ship may only be used if it is inspected for faults every 3 years. The 2020 inspection was done on 31 December 2020 and is included in the purchase price, although the exact cost thereof is not known. The next inspection is due on 31 December 2023. The expected cost of this future inspection is 400,000 Rand, and the present value thereof is 300,000, discounted to 1 January 2021. Show how this should be journalized. So here, when we bought the asset, it was purchased for 1.3 million, okay? And the economic life of the asset is 10 years, or the ship, okay, is 10 years. But it says that the ship can only be used if it's inspected for faults every 3 years. So included in this price of 1.3 million is the inspection that was done 1 year ago. Okay. However, we don't know what the cost is. So when we now need to record the asset, the ship, this 1.3 million, we need to decide what value is attributable to the previous inspection. Because remember, the previous inspection was done 1 year ago, but it's going to last 3 years. So if it was done 1 year ago, 1 year is gone, it's still got 2 years left of the inspection. So we need to separate this value of 1.3 million, what relates to the inspection, what relates to the actual ship structure. So we don't know what the previous inspection cost. So we need to look in the future and see what are expected, how much do we expect to pay in the future for an inspection? And they're telling us that the expected cost of this future inspection is 400,000, but this 400,000 will only be in 2 years' time. So we need to present value that 400,000, and they tell us that the present value is 300,000 discounted to 1 January 2021, which is the date that the ship was purchased. So we now need to use that 300,000 and say this is the value of the ship inspection cost. Okay. So let's have a look at our journals. So we want to record this ship in our books. So remember I said that we're going to apportion it between the inspection cost and the rest of the ship structure. So we said that the ship major inspection is going to be valued at the present value of the 2023 inspection cost. We do not know the value of the inspection when it was purchased, so we are looking into the future and saying, look, in 2023, the inspection is going to cost 400,000. Then we are present valuing that 400,000. So we are taking the present value, which is 300,000. And we're saying that on acquisition of this ship, the ship major inspection is costing 300,000. So we're splitting the purchase price of the ship between these two. So we have debit ship structure cost, which is 1 million. So we work that out by taking the 1.3 million, which is the purchase price that is paid for the ship, minus the 300,000, which we are saying is the inspection cost. So the ship structure is valued at a cost of 1 million. So we're debiting ship structure cost with 1 million. Then we are debiting ship major inspection with 300,000, which is the present value of the future cost of the inspection. Then we are crediting bank, okay, with the 1.3 million, which was the purchase price of the ship. So you can see we've apportioned these two items. They are significant components and they have a separate useful life. So now at the end of 2021, we need to process depreciation. So we are going to depreciate the ship structure separate from the inspection. So let's depreciate the ship structure. So the ship structure is 1 million rand. The residual value is 0 and the useful life is 10 years. So that is going to give us a ship structure accumulated depreciation of 100,000. Then we have the ship major inspection. So we said the ship major inspection was valued at 300,000 on acquisition date, and it has a useful life of 3 years. So the ship inspection was done on 31 December 2020, okay, which was a day before the asset was purchased. So it has a remaining useful life of 3 years. So we're going to take the major inspection cost of 300,000 divided by 3 years, and that will give us 100,000 rand. So we have credited ship structure accumulated depreciation with 100,000, and we have credited ship major inspection with 100,000. We need to debit depreciation with the total of those two, which is 200,000. Okay, so it says here that the 2023 inspection was not recognized at 31 December. Okay, so what it's saying here is that the next inspection is due on 31 December, and the cost of that inspection is 400,000 Rand. So we are not recording that inspection. We are simply using these estimates, using the present value of the future inspection, which is 300,000, to determine what portion of the purchase price relates to the inspection. So here, we are not actually recording the inspection that is going to happen in 2023. We are just using that information to estimate the value of the 2020 inspection that was already performed. Okay. So that is the major inspections. Okay, so we looked at how to depreciate it and how to record it. Now we need to look at derecognition. When do we derecognize an item of property, plant, and equipment? So an item of PPE must be derecognized when it no longer meets the definition of an asset and recognition criteria. So this will happen on disposal or when no future economic benefits are expected from its use. Disposals occur if an asset is sold, destroyed, donated, scrapped, or permanently withdrawn from use. So when we derecognize PPE, so we've said on disposal or when no future economic benefits are expected. So at that time when we derecognize property, plant, and equipment, we need to determine, is there going to be a gain or loss on this disposal? Is there going to be a gain or loss? And we determine the gain or loss by taking the proceeds on disposal less the carrying amount. Okay, so we may be disposing an asset and someone is going to pay us 20,000 Rand for that asset. So that is going to be the net disposal proceeds, okay, the 20,000 Rand. And if that asset has a carrying amount of 10,000 Rand, then the gain is going to be 10,000 Rand. Okay, so we need to determine again if there's a gain or if there's a loss on disposal, and then we will derecognize that asset. So these are the steps that we're going to follow when we derecognize an asset. So we need to remove the carrying amount from the accounting records, meaning we're going to remove all its related accounts, costs, accumulated depreciation, and accumulated impairment losses. So we are going to remove this from our accounting records. Then we're going to determine and recognize the proceeds on disposal. So the amount of these proceeds is measured. Okay, so the proceeds are not going to be recorded as revenue. The proceeds are going to be, so we are going to record the proceeds generally in our bank account, okay? So it's not going to be recognized as revenue. But if we have a gain, so let's go to the next one where we have offsetting. So we're going to set off the cost against, or the carrying amount against the proceeds on disposal. So the expense is going to be the carrying amount and the income is the proceeds. So we set off those against each other in an account known as a disposal account. And then we need to determine if we have a gain or a loss on that disposal account. So when we recognize the carrying amount as an expense and we recognize the proceeds as income, we are going to process this in one account called a profit or loss on disposal account. If we have a gain, the gain cannot be classified as revenue. It is simply classified as income in profit or loss, okay? And if we have a loss, this is going to be an expense recorded in profit or loss. So we have our steps. We're going to remove the carrying amount from the accounting records. We're going to determine the proceeds on disposal, and then we're going to use that to determine if we have a gain or loss on disposal. And just to remember here, the disposal is recognized when the risks and rewards of ownership pass from the seller to the buyer. Okay. So let's just recap that, and then we'll look at an actual asset disposal account. So we need to calculate the carrying value on the date of sale or date of disposal. So the cost of the asset must be derecognized. So when we bought the asset, we debited the cost. So now we are removing the cost of the asset. We are going to credit the cost of the asset. Then any accumulated depreciation relating to the asset must be eliminated. So when we process the accumulated depreciation, we credited that. So now we are removing the accumulated depreciation, so we are debiting it. We are eliminating the accumulated depreciation. Any accumulated impairment relating to the asset must also be eliminated by debiting that account. And then we're going to determine the profit or loss. So the profit or loss on disposal must be recognized in the statement of profit or loss, which is the statement of comprehensive income. Okay, so that is the process we are going to follow. Let's have a look at the accounts we'll debit and credit. So we are debiting back. This would be with the proceeds that is received for the asset. Then we are debiting accumulated depreciation to remove the accumulated depreciation from the books. Then we are going to credit the PPE cost to remove the cost from our books. If we find we have a loss on disposal, we will debit that loss. If we have a gain on disposal, we will credit that gain. So when do we have a loss and when do we have a gain? So a loss will be determined if the proceeds from disposal are less than the carrying amount of the asset at the date of disposal. And then when do we have a gain? So if the proceeds from the disposal are greater than the carrying amount of the asset at the date of disposal. So, and remember, a loss is debited and a gain is credited. So how do we show this in an asset disposal account? So if we have a loss, this will be our asset disposal account here. We will debit the cost of the assets. So this is the asset disposal. So this helps us determine the loss on disposal. So you'll debit the asset cost in the asset disposal. We'll credit the accumulated depreciation and credit the bank. And this will then determine what our loss is. If we have a gain, then we will still debit the asset cost and credit the accumulated depreciation in the asset disposal account. So we're showing like the other side of the journal entry. And then we'll show bank on the credit side of the asset disposal account. And then the remaining amount will be the profit on disposal. Okay, so just remember, yeah, so this account will show you if you have a profit or loss, if you cannot determine it. So let's have a look at an example. So here we have an entity. They acquired a computer on 1 July 2017 at a cost of 100,000. At acquisition, the computer had an estimated useful life of 5 years and a zero residual value. The company depreciates the computer on a straight line basis. On 31 March 2020, the computer was sold. The entity made a profit of 15,000 Rand. So assuming the year end is 30 June, calculate the missing amounts. So here we are given the computer cost, which is 100,000. We are told that the profit on disposal of the asset is 15,000. We need to determine what the other things are. So we don't know what the proceeds are. We need to determine the accumulated depreciation and what the loss is. So let's have a look at an example. So the question told us that the cost is 100,000 Rand, and we can use the cost to determine the annual depreciation. So they told us in the scenario that there's a zero residual value and the useful life is 5 years. So we can work out the annual depreciation by taking 100,000 Rand divided by 5 years, and that will give us an amount of 20,000. So that is the annual depreciation. So the asset was bought on 1 July 2017, and our year end is 30 June. So if we go from 1 July 2017, which was when the asset was purchased, to 30 June 2018, that is 1 year of depreciation of 20,000. Then in 2018, from 1 July 2018 to 30 June 2019, that is another 20,000 of depreciation. Then we have from 1 July 2019 to 31 March 2020, that is 9 months. So we will prorate the depreciation, and that will give us 15,000 Rand of depreciation. So our total accumulated depreciation is 55,000. And then we can work out what the carrying amount is by taking the cost, which was given of 100,000, minus the accumulated depreciation of 55,000, and that will give us a carrying amount of 45,000 Rand. So now we know what the cost is, we know what the accumulated depreciation is. Now we need to work out what is the proceeds. So in this scenario, we're not given the proceeds, but we are given the profit made on disposal, which is 15,000 Rand. So we are going to use the formula to calculate what the profit is. Sorry, we're going to use the formula to calculate the proceeds. So our formula here is going to be gain equals proceeds minus carrying amount. So we know what the gain is. We were told there's a profit of 15,000 Rand. The proceeds is 45,000 Rand. Yeah, the proceeds, so the gain is 15,000 Rand. The carrying amount is 45,000. So we're going to work backwards and use that to give us the proceeds, which is 60,000. So if you look at this equation here, we are going to bring the 15,000 across and then take the proceeds to the other side. So the proceeds is going to be 15,000 plus 45,000. So that is 60,000. So now we know what the proceeds is. It's 60,000. So now we can fill in, we have all of the information. So we know that the proceeds is 60,000. We worked out our accumulated depreciation, which is 55,000. The computer cost was given of 100,000, and the profit on disposal of the asset was 15,000. So we know all of these amounts. Okay. So that is derecognition. Now we need to go through something which is new to you. This is change in estimates. So the measure of an item of property, plant, and equipment, it basically reflects its carrying, is reflected in its carrying amount and is made up by its initial measurement and subsequent measurement. Okay, so when you look at the carrying amount, that carrying amount was determined by the depreciation method, okay, and any impairments. So subsequent measurements involves using the cost or the revaluation model, depreciation, so this reflects the usage of the asset, and impairments, so this reflects any damage to the asset. So subsequent measurement involves all of these three things. So under the cost model requires assets to be recorded at cost, less accumulated depreciation and accumulated impairments. So no adjustments are made for any increase in the value of an asset. So remember, under the cost model, we do not increase the value of the assets, okay? That is only under the revaluation model. But the residual value, the estimated useful life, and depreciation method, these must be reassessed at least annually, okay? These may change. These are estimates, okay? So as time goes on, these estimates may change because more information becomes available. So any of these estimates may be changed during the depreciation period. So adjustments to these estimates are made prospectively, which means at all future periods, so looking forward. So when we are going to change an estimate, we're not going to go in the past, okay? For our purposes, we're only going to make the change going forward. So let's have a look. First, let's recap depreciation, and then we'll get into a change in estimate. So when do we begin depreciating? So depreciation starts when the asset is available for use, when the asset is in the location and condition necessary for it to operate in the manner intended by management. When do we stop depreciating? So depreciation stops when the asset is sold, scrapped, permanently removed from use, reclassified as available for sale, fully depreciated, which is when your net book value equals your residual value. So depreciation doesn't stop if the asset is temporarily removed from use or undergoing repairs. So the debit for depreciation, this is going to be determined based on certain estimates. So based on the estimated pattern of usage of an asset over time, how is it going to be used? Based on the estimated residual value of the asset, based on the estimated remaining useful life of the asset, and the estimated production capacity if applicable. So how do we determine the depreciation? We calculate that by taking the cost minus the residual value divided by the useful life. So these items cannot always be precisely measured, okay? So we make an estimate. So for the useful life, when it's given in a question, that is an estimate. That is how the company expects to use the assets, but it can actually change. Something can happen and the expected usage of the asset will change, and then we need to change the estimates. So if an entity decides that any one of the three variables of depreciation needs to be changed, this must be adjusted for as a change in estimate. And the accounting standard is IAS 8, which is Accounting Policies, Errors, and Estimates. Okay, so we need to look at a change in estimate. Okay, so there are two methods or ways you can do a change in estimate: the reallocation method and the cumulative catch-up method. So we are going to only look at the reallocation method. The cumulative catch-up method has been scoped out. So we will only be focusing on the reallocation method. So what is the reallocation method? So under this method, no adjustment is made in the current year for the effect of the change in the prior year. The recalculated depreciation expense is used for the current period and all future periods, or until there is another change in any of the estimated variables. So the simplest way to think of this is that if we have a new asset, so when we have a change in estimate, we need to think about the item as if it were a new asset and to use the asset's carrying value as the new cost and depreciate it to the new residual value over the remaining useful life based on the new method of depreciation. So for example, the opening carrying amount of plant calculated based on the previous estimate, this is simply going to be reallocated over the remaining revised estimated useful life. Okay, so it sounds confusing, but I think the best way is to do an example. Okay, so we have an example here from the textbook. So here, machinery was purchased on 1 January 2007, on which date it had an estimated useful life of 5 years and a nil residual value. So the carrying amount on 31 December 2008 was 300,000. So the cost was 500,000. Then we had accumulated depreciation for 2 years, which was 200,000. Then we had the net carrying amount on 31 December 2008, which is 300,000. On the 1st of January 2009, the total economic useful life was re-estimated to be 4 years. Okay, so if we look here, see, so the machinery when it was purchased, on the purchase date, it had an estimated useful life of 5 years. Then on 1 January 2009, the useful life was re-estimated to be 4 years. So there was a change in estimate. The useful life has changed. So on the 1st of January, the best estimate we had of the useful life was 5 years. So we depreciated on that 5 years. So we had depreciation for 2007, which was 100,000, and then depreciation for 2008, which was another 100,000, and that gave us the amount of 200,000, which was the accumulated depreciation for those 2 years. That was based on the estimate that was available at the time. But now more information may have become available, the useful life or the way we use the asset could change, and the useful life is now being re-estimated to 4 years on the 1st of January 2009. So we need to know how are we going to deal with this, okay? Because there has been a change in useful life, and this is going to affect the depreciation going forward. So let's follow these steps. So if we break it down into steps, it becomes a lot more clear. So there has been a change in the useful life. It was 5 years when the asset was purchased. Now it is 4 years, 2 years later. So therefore, the depreciation expense is definitely going to change. So step 1, we need to calculate the carrying value at the beginning of the current period. So in the scenario, the estimate changes on the 1st of January 2009. So in the question, the carrying amount was given on the 1st of January 2009 as 300,000. And the total useful life was re-estimated to be 4 years on the 1st of January 2009. So the carrying amount, we've calculated that at 300,000, and the useful life has been re-estimated to 4 years. Now we're going to apply the new estimate over the remaining useful life. So they have just told us that the total economic useful life was re-estimated to be 4 years. But remember, we've already depreciated for 2 years. So 2 years have already passed. We've already depreciated for 2 years. So if our total economic useful life was re-estimated to be 4 years and 2 years have already passed, it means that we have a total remaining useful life of 2 years. Okay, so when we got that re-estimate of 4 years, this was based on the total economic useful life. But we need to ask ourselves, how many years was the asset used and depreciated for? It was already depreciated for 2 years. So we take the total economic useful life minus the depreciation already processed to determine the remaining useful life. So our goal is to determine the remaining useful life, which is 2 years. So now in order to determine the depreciation based on the new estimate, we're going to take the carrying amount of 300,000 divided by the remaining useful life, which is 2 years. And that will give us depreciation for 2009 of 150,000 Rand. Okay. Do you guys have any questions on this so far? So remember, our step is to calculate the carrying value at the beginning of the current period. This was given at 300,000. Then step 2, we need to apply the new estimate. In this situation, the useful life has changed, but we need to apply it over the remaining useful life. So the remaining useful life here is not the same as the total useful life. So in the scenario, the useful life, the total economic useful life was re-estimated to be 4 years. But the total economic useful life, this is as if the asset was new, but we know that the asset has been used for 2 years. So we need to determine the remaining useful life, which is different to the total economic useful life. So the total economic useful life was re-estimated to be 4 years. As 2 years have already passed, the remaining useful life is going to be 2 years. So we take the total economic useful life, which is 4 years, minus the 2 years that have already passed, and that will give us a remaining useful life of 2 years. Then we use that 2 years to calculate our depreciation. So our depreciation for 2009 is 300,000, which is the carrying amount, divided by the remaining useful life, which is 2 years, and that will give you 150,000 Rand. So in the scenario here, it says show the journals assuming that the 2009 depreciation journal had not been processed. So if no depreciation has been processed, then we will record a journal relating to this amount here. So we need to record this amount as depreciation, which is 150,000 Rand. So you know we will debit depreciation. Okay, this is part I. We will debit depreciation with 150,000 and we will credit machinery accumulated depreciation with 150,000. Okay, so the accountant has processed the depreciation based on the depreciation that we calculated. So this is part I. Now, if we go to part B, show all depreciation journals that would be processed in 2009, assuming that the 2009 depreciation journal had already been processed, so before the change in estimates. So here we are saying that the accountant already processed the depreciation journal based on the previous estimate. So if the accountant had processed the journal based on the previous estimate, it would have continued to depreciate the assets at 100,000 Rand per year. So the accountant would have processed the journal by debiting depreciation with 100,000, crediting machinery accumulated depreciation with 100,000. So the accountant processed the depreciation based on the old estimates and then realized that that estimate had actually changed. So they processed depreciation at 100,000, but based on the new estimate, the depreciation should have been 150,000. So because the accountant already processed 100,000 Rand of depreciation, now they're going to record an additional 50,000 Rand of depreciation. So we're going to debit depreciation with 50,000 and credit accumulated depreciation with 50,000. So you'll see that under part I, which is this journal, the total depreciation processed was 150,000. Under part 2, the accountant processed a total of 150,000 Rand depreciation as well. So the totals are the same, but under the second part, the accountant recorded the depreciation based on the old estimate and then realized the estimate had changed. So they had to process additional depreciation of 50,000. Okay, do you guys understand that? Okay, it might seem a bit confusing because it's new, but if you follow the steps, it's going to be fine. Okay. So let's have a look at another example just to recap what we did. So here we have another example, which is a change in estimated residual values. So machinery was purchased on 1 January 2007, on which date it was estimated to have a useful life of 5 years and a nil residual value. The carrying amount on 31 December 2008 was 300,000 was the carrying amount, and this is made up of cost of 500,000 and accumulated depreciation of 200,000. So the net carrying amount at 31 December 2008 is 300,000. So they've processed depreciation here for 2 years. The depreciation can be worked out by taking the cost of 500,000 divided by 5 years, which is the useful life, which will give us annual depreciation of 100,000. So on the 1st of January 2009, the residual value was re-estimated to be 90,000. So we again are going to follow our steps and we're going to calculate the effect of the change in estimate, and then we're going to process our journals. So let's have a look at our steps. So what has changed here? The residual value has changed. On 1 Jan 2007, the residual value was nil, but now on 1 Jan 2009, the residual value has been re-estimated to be 90,000. So the first step we need to do is to calculate the carrying value at the beginning of the current period. So we need to calculate the carrying value on 1 January 2009. So the question actually gives us the carrying value. So they're giving us the carrying value on 31 December 2008. This is the same as 1 Jan 2009. So the carrying value given in the scenario is 300,000. Okay, you happy? That's the carrying amount. Then we need to apply the new estimate, which is a change in residual value, over the remaining useful life. So in the scenario, what is the remaining useful life here? So we were told on 1 January 2007, the total useful life was 5 years. We depreciated for 2007, and then we depreciated for 2008. So included in here is 2 years worth of depreciation. Our total economic useful life was 5 years. We have used 2 years already. So our remaining economic useful life will be 3 years. It is that amount left over. Okay, I'll just repeat that to make sure we're clear. We need to determine what is our remaining useful life. In the scenario on 1 January 2007, the total economic useful life was given as 5 years. This was on the purchase date of 1 January 2007. We depreciated for 2 years. So we depreciated for 2007 and we depreciated for 2008. So 2 years have gone by. So what is our remaining useful life? We will take our total useful life, which is 5 years, minus the 2 years depreciation that we have already processed, and that will give us a remaining useful life of 3 years. Okay, so the total economic useful life is 5 years. 2 years have gone past, so the remaining useful life is 3 years. Now we can process the depreciation for 2003. So our carrying amount was 3,000 Rand. That is going to become almost our new cost minus the residual value. Remember, the residual value was nil on purchase date, but now it has been re-estimated to be 90,000 Rand. So we're going to say 300,000 Rand minus 90,000 Rand residual value divided by our remaining useful life, which is 3 years. So if we do that in our calculator, that will give us 70,000 Rand worth of depreciation. Okay, so that is the change in estimate. So now we need to have a look at part B. So what does part B say? Show all 2009 depreciation journals, assuming that depreciation had not yet been journalized. So if the accountant had not processed the depreciation yet, we have just determined that the depreciation for 2009 should be 70,000. So we are going to process our journal entries. We're going to go debit depreciation with 70,000. Credit machinery accumulated depreciation was 70,000. So this is the journal that the accountant would need to process based on that new estimate. Now, what happens if the accountant, they had already processed the depreciation based on the old estimate, okay? But now the residual value changed. So based on the old estimate, the accountant would have gone 500,000, which is the cost, divided by 5 years, which gives 100,000 Rand depreciation. So if the accountant had processed the depreciation based on the old estimate, the accountant would have gone debit depreciation 100,000, credit machinery accumulated depreciation 100,000. But, so the accountant processed 100,000 Rand worth of depreciation, but they should have actually processed 70,000 Rand. So the accountant processed the depreciation before the estimate changed. So now the accountant realized that the depreciation should have actually been 70,000 Rand, but they processed 100,000 Rand. So now this is going to result in too much depreciation. So then the accountant will reduce the depreciation journal by saying debit machinery accumulated depreciation and credit depreciation. Okay, so we're debiting machinery accumulated depreciation and we are crediting depreciation because this 100,000 Rand is too much. We processed too much depreciation. Based on the new estimate, it should be 70. So how do we go from 100,000 here to 70,000 Rand? We need to reduce this debit to depreciation and we need to reduce this credit to accumulated depreciation. And we do that by processing this 30,000 Rand journal, by debiting machinery accumulated depreciation and crediting depreciation. Okay, so that is a change in estimate, guys. I know it can seem confusing because it's new, but if you go through these slides and you attempt your tutorial and practice questions, I'm sure it will become clear. Okay, so let's move on. We only have about 10-15 minutes left. Let's move on to presentation and disclosure. So presenting and disclosing property, plant, and equipment will involve all of the following financial statements: the statement of financial position, the statement of comprehensive income, the cash flow statement, which we'll cover in semester 2, and the statement of changes in equity, which we'll also cover in semester 2. Then we also have notes to the financial statements. So we'll have to perform a property, plant, and equipment reconciliation note. There's also an accounting policy note and profit before tax note if profit or loss section is prepared and analyzed by function. Okay, so it depends on whether the nature method is used or the function method is used. Let's have a look at the statement of financial position. So what will go in the statement of financial position? So the property, plant, and equipment, it must be presented as a single line item in the statement of financial position. So here under assets, remember we'll have non-current assets and current assets. Property, plant, and equipment is a non-current asset and it will be shown as a single line item, and then it will be referenced to the property, plant, and equipment reconciliation note. So all the calculations in detail will be contained in the property, plant, and equipment reconciliation note. So the reconciliation note reconciles the opening and closing balance of PPE. So this will show the gross carrying amount and it will also show the accumulated depreciation. So let's have a look at an example of the reconciliation note. I'm sure you have seen it from second year. So here we will have a column for the assets. We'll have the cost price, the original cost of the assets. These are the opening balances and the accumulated depreciation. And if we want to know the carrying amount, we'll take the cost price minus the accumulated depreciation, and that will give the carrying amount at the beginning of the year. Then we have movements during the year. We have acquisitions or additions. If we purchase new items of PPE, we'll add that in. If we have disposals, we'll record that as well. Obviously, the disposals and the depreciation must be shown in brackets to show that the value of our property, plant, and equipment is reducing. Then we have carrying amounts at the end of the year. We have the cost price and the accumulated depreciation. And these amounts will obviously take into account the movements. And this will give us the carrying amounts at the end of the year. Then we have an accounting policy note. So this is an example of accounting policy note. So it'll just give us a bit of description about the property, plant, and equipment. So here it says the PPE is shown at cost less accumulated depreciation. and the cost model is used. So it tells us that depreciation is not provided on land. The depreciation is provided on all other PPE over the expected economic life to the expected residual values. Depreciation is provided on the following assets using the following rates and methods. So they'll tell you what each item is and how it is depreciated. So in this example, plant is depreciated on a straight line basis over 10 years, and equipment is depreciated on the diminishing balance method using 20% fixed depreciation rate. Okay, so for each class of PPE, you need to disclose the depreciation method used, like the useful life, whether it is depreciated on 20% per annum, and the measurement model used. Is it the cost model or is it the revaluation model? Okay, so all of those items must be disclosed. Then we have the statement of comprehensive income. So here, income and expenses relating to an item of PPE will affect the statement of comprehensive income by decreasing profit or increasing profit. So those items that decrease profit are things like depreciation expense, impairment loss expense, and loss on disposals of property, plant, and equipment. Then we have the items that will increase profit if we have a reversal of an impairment or a profit on disposal of PPE, that will increase profit. Okay, so all of these items will be shown in your statement of comprehensive income. Then we have presentation. So this depends on how the profit or loss section of the statement of comprehensive income is presented. So depreciation expense and other expenses will be presented differently on the face of the statement. So if we use the function method, then the income and expenses are included in one of the line items classified by function. So we'll have those expenses relating to administration, and depreciation and loss on disposal will be included there. Other income under the function method would include things like profit on disposal and profit on exchange of assets. So the nature of the amount of the separately disclosable income and expenses must then be disclosed in the notes to the financial statements. Okay? Then if we use the statements of comprehensive income, which is the nature method, here income and expenses are presented separately by their nature on the face of the statement of comprehensive income. Okay, so usually we follow the nature method where we show the depreciation and we show the loss on sale of an item of PPE. We will show the profit on sale of PPE, and then we'll show like interest expense. So we usually use the nature method. So our focus is on income and expenses presented and analyzed by nature and not by function. But if you are one day asked what is the function method, then you will say it's when the income and expenses are grouped according to their function. Okay, so that is presentation. Now we have an example here of how to disclose. It's an example basically on presentation and disclosure, okay? So I'll post extra calculations to this, but I just want to show you here. So remember we said that property, plant, and equipment, it's shown as a line item. So in this scenario, we had 2001, 2002, 2003, and 2004. So the property, plant, and equipment was shown as a line item here. And then all of these amounts come from the note 4. So in your tests and exams, this is what you must do, okay? Obviously, we need to know how you got these amounts, and that will be shown in the reconciliation. So in this example here, they did a reconciliation from 20x1, and they showed the opening balances here, and then all of the movements, and then the closing balances over here, okay? So have a look at this example. I'll post some additional calculations if you want to do this question for homework, but it shows also the accounting policy note, which tells you that the cost model is used, and then it tells you the method of depreciation, which was 25% per annum for the plant. And then it shows you profit before tax here. So all of these items would affect the profit before tax. It disclosed the depreciation separately, and then it disclosed the impairment loss. And in this scenario, there was an impairment loss reversed, which it also showed. Okay. So that is the end of the lecture, guys. This is just a recap that you can go through in your own time. So what did we do today? We looked at subsequent costs. We looked at how to de-recognize an asset, and we looked at a change in estimate, and we looked at presentation and disclosure, which you should be semi-familiar with from last year. That is the end of the lecture, guys. I'll post the recording, and for that last example, I have some additional calculations if you guys want to have a look at it later on. Do you guys have any questions you want to ask?